Hello and welcome. You tune into Your Trades with me, Ankita Saxena, and with me, Shreyansi Singh. And this is a show where we get you the roundup of the market and what is going to be the trade setup perhaps for tomorrow's trading session. But first up, let's see how the markets fared today, Shreyansi. What a day in the markets. A good start to the week. Look at the levels that we are at. It was a one-way upside. There was no sell-on rise happening there. And we've managed to cross the psychological level of 24,000.
Well, absolutely. Just when we started, it was unclear whether this sort of resilience is going to be going into the day while we shut shop. And once you look at the close, it's quite a sea of green that you're seeing coming in there, because as far as the Nifty is concerned, managed to hold up quite above those 24,000 levels for the Nifty. And even when you take a look at the top sectoral gainers, you have some decent gains that you did see. All of these indices, the likes of energy, PSU Bank, even IT as well as realty, eke out gains from anywhere between 2 to 2.5%. That's the kind of uptick that you saw coming in for some of those indices. Even the ones that were trailing, that were following all of these, were eking gains from anywhere between 1.5 to 2%. So I'm talking about auto, metal, PSC as well as commodities. And on the flip side, of course, you did have FMCG. That's the one that held on to just a tinge of red at this point. That's largely the kind of picture that you saw coming in. It was some of those IT counters that were buzzing away in trades. So the likes of Tech Mahindra up 5%. That's the one. Infosys, as you can see on your screens as well, 2.5% uptick coming in for that one as well, despite a muted quarter coming in for Infosys. So some resilience despite muted earnings thus far. For the IT pack is what you saw coming in. And other than that, of course, it was banks that were buzzing away in trade. So the likes of Indices Bank. And you did have Axis Bank as well, that was up 2.5%. Even heavyweight Reliance held up quite well, 1.5% uptick coming in, even for that one. But even when you take a look at the flip side, the losses are not that bad. The shade of red is not really that deep when you take a look at the losers as well for the Nifty pack, because you do have ITC as well as HUL down above 1%. But other than that, Cipla, Grasim Industries, Bharti Airtel just holding on to a slight tinge of red. So that largely is the kind of picture that you saw emerging as far as some of those indices were concerned. So good news coming in there as far as the start to the week is concerned. It was, of course, a strong quarter. The fourth quarter, in fact, was quite strong for ICICI Bank as well as HDFC Bank. And like I said, muted quarter four for IT majors. But despite that, Ankita, we did see some sort of strength coming in as far as IT is concerned.
Yeah, absolutely, Shreyansi. In fact, we did see strong buying coming in IT after the drawdown that we've seen in the IT counters. A big reversal coming in there. And a couple of other things that made two headlines was the fact that US Vice President J.D. Vance is in India. He was seen alighting the flight with his family, and he will be here for the trade talks. And, given that also our Finance Minister Nirmala Sitharaman is in the US trying to strike a bilateral deal with the US, and she mentioned that this is the first tranche of the meeting, that the first phase of meeting that has begun, and it should conclude by fall this year with the positive results coming out. Besides that, we also have the IPO of green PSUs that are experiencing a bit of a delay due to combination of factors, including market conditions, investor sentiment, and regulatory scrutiny. So we do see a delay coming in as far as the green PSUs listing is concerned. So that was the top news for the day. But let's go across to Ruchit Jain, who's the Vice President of Equity Technical Research, Wealth Management, Motilal Oswal Financial Services, joining us now. Hi, Ruchit. Thank you for joining us today. Ruchit, the good start to the week. In fact, we have managed to cross the psychological level of 24,000 on the Nifty. Nifty Bank, of course, leading the rally. There's no stopping for Nifty Bank. Tell us what are the levels that you're working for Nifty and Nifty Bank.
Yeah, hi, very good afternoon. Well, I think the good thing is that this entire up move has been supported by a good broad market participation, where the market breadth remains quite positive, and we have seen that the immediate resistance which was there of 23,700, 23,750, which was the previous swing high, has been surpassed with an ease. So I think markets should see a continuation of this momentum. 24,250 would be the first level that we are watching out for. And ultimately, we believe that market should head towards 24,500, where the 61.8% retracement of the entire correction from the top to recent bottom has been seen. So I think the overall momentum remains positive. There may be some shift of sector-wise momentum, where banking and NBFCs, although has been one of the strongest sector, but the momentum readings are now going into but overbought zone over there. But you can see several of the other sectors, such as defense is there, where some good positive momentum has been seen. Certain chemical stocks are there where fresh breakouts have been seen. So I think some sectoral rotation could be there, but overall markets are expected to continue to march higher, and any kind of declines towards the 23,800, 700 would now be seen as a immediate support.
Absolutely. So defense is looking quite interesting on the back of those gains coming in. But tell you what, Ruchit, even when you take a look at the IT pack, right, you do have a Tech Mahindra holding on to gains of over 5% thereabout. Infosys as well, up 2% despite that muted set of earnings coming in for Infosys. So what are you seeing when it comes to the entire IT pack? Because there's still a lot of resilience there.
So we have seen a very sharp price-wise correction in most of the IT names, on the back of this entire US news flows regarding trade war which was going on. Now, if you look at the Nifty IT's all-time high in the month of December, it was around 46,000, and right now we have formed a low of 31,000. So it's a very sharp correction that we have seen over last 4 to 5 months. So I think it's just because the momentum readings are a bit oversold post the sharp correction, and no, hence we are witnessing some pullback moves. But frankly, it's very early to guess it that the worst is over or the bottom has been made for the IT names. So as of now, I think one should take this as a pullback move only because of some oversold setups on the technical charts.
All right, point taken, Ruchit. But thank you so much for joining us. We will let you go on that note. But moving on to what is really aiding the Indian market, and that's the cooling of the dollar index, which has slipped below the 100 level. Now, waning investor confidence amid tariffs, rising recession fears is likely denting the index. What is denting the index more? Let's go across to my colleague Sharad, who's standing by with the details of what's ailing the dollar index. Over to you, Sharad.
Well, a very significant number it is when it comes to the 100, when it's dollar index. Now, looking at the downtrend, the lifetime highs was 1984. That's a big aberration and a big history chapter. But 2025 highs, that is important, 110. And see the destruction which has happened. It's gone past, or you could say gone below the 99 levels, a record low happening in the global financial crisis. Now, the significance of dollar index is when it keeps on falling, it gives an indication that the emerging markets are expected to perform better, and they'll have a, you could say, an inverse relation proportion. Now, let's see how the history has pointed out. You could see Black Monday, it was 86, job creation coming in at 81, global financial crisis 71. But the recent ones, Trump's first tariff 1.0, it went down as low as 96. So still there is a gap. Current levels it's 98, and it's on a downward trajectory coming in at roughly 97, 96. These are the levels which some experts have stated. But the benefit happens is overall it's looking at is of course for the emerging markets, and you can see how the dollar index and its constituents happen. So the dollar index almost 58% is given to the euro, and apart from that the major currencies are there which would be in focus, such as the pound sterling, Canadian dollar, Swedish krona, Swiss franc and Japanese yen making it to the list. So this is the entire picture for the dollar index, how it's actually constituted, the relevance of it, and especially for emerging markets and India. And historically, I must suggest that whenever these movements happen, India does much better than emerging markets when this dollar index falls happen. So that's an important number to look out for.
Well, absolutely, Sharad. And we're looking out for that number. There's a lot of moving pieces when it comes to the dollar. There's a lot of headlines that we have coming in as far as the tariff front is concerned. But tell you what, let's also get you the derivatives diary. Let's take a look at the trends as far as index futures are concerned for April expiry. You do have Nifty being, there was a long build-up, in fact, that we saw being observed for the Nifty, and even for the bank Nifty, the same was being observed. When you take a look at the India VIX, completely flat. That's the kind of move that you saw coming in, pushed up around those 15 levels is where India VIX in fact was at. When you take a look at active calls, you did have some call buying that was observed around 24,200, and there was also call buying around 24,300. When you take a look at active puts, you do have put writing that was observed at 24,100 and 24,000 as well. That is the kind of active put levels that you had coming in. So that largely is how the derivative diary is shaping up.
All right, moving on then from the derivatives F&O space, we'll keep it with the earnings then, with heavyweights HDFC and ICICI Bank that posted its quarter four results. So better than expected results coming in for both of them. Chair coming in for HDFC Bank as far as the brokerages was also concerned. We saw margin expansion and also asset quality improvement along with slippages and credit costs. Both banks have stable outlooks, with ICICI saying retail stress has bottomed out and HDFC aiming for CASA gains and a lower CD ratio ahead. My colleague Gaurav is joining in with a comprehensive picture of that. Over to you, Gaurav.
Well, yes, when we talk about HDFC Bank and ICICI Bank, both banks reported a very good set of numbers. In fact, when we look at profitability, both the banks reported above estimated profitability growth for Q4 FY25. But there were other highlights from the quarter. So first, let's talk about net interest margins. Now, both the bank have actually shown some kind of improvement in net interest margins, whereas the street is expecting net interest margins to remain stable or decline a little bit. And when we talk about this gain, it is not just one-off gain. The banks has said that it is actually something that can be factored in even from here on. So first, let's talk about when we talk about HDFC Bank, we have seen 3 basis points of gain in net interest margins, which they have contributed to the cut in CRR ratio. On the other hand, when we talk about ICICI Bank, a 16 basis point of improvement in net interest margin, and bank has clearly stated that it is not actually a one-off thing. It is a combination of multiple things which has actually led to the net interest margins of 4.41. Although the bank has said that from here on the long term basis, 4.3% of FY25 is something that we can look as a representative for the bank, but definitely a very positive thing in fourth quarter. Second is that when we talk about asset quality, both the bank have shown some kind of improvement in asset quality. In fact, when we talk about net NPAs, they have gone down almost by 3 basis points for both the banks. In fact, when we talk about HDFC Bank, we have already seen slippage ratio at 1.2%, which is actually lowest among the peers when we compare it with the large bank so far. Other than that, when we talk about ICICI Bank, there also we saw gross NPAs going down almost by 20 basis points because the bank actually sold one of their portfolios worth 2,700 crore rupees. When we talk about loan and deposit growth, there also we saw very good set of numbers. In fact, when we talk about ICICI Bank, we saw loan book growth was actually a little less than what the street is expecting. But from here on, what bank is saying is that the personal loan and credit card segment has actually, the growth there has bottomed out. And from here on, bank will continue to grow at a pace which will be faster than the system. On the other hand, when we talk about HDFC Bank, we already knew that in FY26, HDFC Bank wanted to grow at a system level space, and they have continued to believe that as well. In fact, what they have also said is that the CD ratio will come down to around 85 to 90% gradually. So definitely another key trigger here. And lastly, when we talk about way ahead, there also we are seeing some kind of positive triggers coming up from the commentary from banks. So when we talk about ICICI Bank, although both the banks have agreed that the rate cut impact is going to be seen in Q1 FY26, but the increase in CASA and deposit growth is something to be watched out for, and that is the reason why they believe that the impact on the net interest margins will be limited. So definitely a very positive set of numbers from both the banks, and on back of this, we have already seen that brokerages have also upgraded the target price, and on back of this, we will also be watching out on how the stock will perform. But as of now, Q4 was a very strong set of numbers for both the banks.
Well, absolutely. And when you take a look at the performance coming in for both of these banking heavyweights, you did have HDFC Bank shutting shop with gains of upwards of 1%. ICICI Bank as well, 0.2% uptick coming in as far as that particular counter is concerned. But tell you what, let's also get you some key commentary coming in. Let's go across and listen in to what Ajay Srivastav then had to say about these banking majors.
PSPs always kind of flatter to deceive you in the end, because valuation wise, I think they're dirt cheap. They're rock cheap. You can't get cheaper than this price to book for less than 1 Ps and for 5 or 7s or thereabouts. And, so, there's nothing which tells us that why you should not buy a stock which is so low valued, but also tells you why it is lowly valued. PSU banks are a difficult proposition because they don't compete in the market. They're there spread over historical, they're losing their market share. At the end of the day, you don't bank with the PSU stock. Maybe SBI, leave it aside for a minute, but by and large, the people of India, or at least the HNI segment, do not bank with these banks. So future-wise is less than perfect. Valuation-wise, it couldn't have been a greater story to buy into, and it may well turn out to be. When, I do not know. But the fact remains, they're one of the cheapest stock in the Indian financial market. Now, up to you. You want to hold it for how long and wait for the government to do something to the banks, or just piggyback on a private bank and says, these are banks today which are so beautifully positioned because there is no foreign competition in India. After exit of Citi, actually there is no foreign competition in any of the banks in India, unlike any other sector, barring telecom, perhaps. So therefore, position-wise, private banks look a lot better. Valuation, one can't argue. There's no argument to say why should not buy PSU banks. It's incredibly cheap, but well, you have to be patient with them.
All right, moving on then. As banks kick off the earnings season on a strong note, IT players remain rather cautious amid mounting global uncertainties. All four major share a weak guidance, even as results come in mixed. My colleague Sharat is joining us with the roundup of this. Even as results come in mixed. My colleague Sharat is joining us with the roundup of the numbers for four IT majors.
Well, overall, if we're saying on a long-term basis, there is a question mark coming in that what would be the sustenance numbers going ahead for the IT companies, the muted performance coming in the third quarter from the large cap IT companies. Also, of course, the expectations also for this quarter have been modest. Now, there is no cancellation of orders currently, but there would be a delay in the decision making, and that doesn't augur well for the IT segment. The clients also prioritizing much more on the cost optimization and how the budgets will actually pan out. That is something to watch out for. And importantly, I would also like to point out is the discretionary spends that has remained still soft, and they have been remained soft over the last 1.5 to 2 years as the client is continuing to focus on cost cutting as well. Interestingly, headcount addition that is low now, and that we could have seen in Infosys numbers as well. The key concern being the continuous delay which is happening because of the spending due to the tariff issues coming in. Now, interestingly, the key highlights are actually looking a bit decent. That is that the healthy deal wins are still there, but the guidance for FY26 that still remains healthy. Now, the IT index performance, they have been significantly underperforming Nifty. Interestingly, post correction, the valuation has become a bit more realistic. The weightages which was there of IT in the Nifty index, that has actually significantly down from almost 18% to 12%. Nifty IT index last 3 months is down 21% as compared to Nifty performance, which is in the green, which is more than 3% right now. And IT sector overall analysis, if you look at it, the numbers over there, main thing is the guidance, the overall the revenue margins, they have been stable as expected, what has come in the overall report card, but the main thing is the revenue guidance, especially for FY26 Q1, that has not been encouraging. The valuations after corrections, they are looking attractive. Perhaps that might be the reason of some buying in today's trade today. Wipro, that's the numbers are coming almost, you could say, below that 5-year averages in Infosys and TCS as well. So it'll be very interesting to get to know about other IT companies also as they come out with their results this week.
Well, absolutely, Sharad. Numbers below those averages coming in as far as Wipro is concerned. When you take a look at the rest of the IT majors as well, it's been quite the muted quarter for the fourth quarter, and there's a lack of visibility. But despite that, you did have the stock that was unperturbed by all of that. Tell you what, let's also go across to what Rahul Jain, who's the VP at Research, Dolat Capital, had to say when it comes to some of these IT companies. Does he see a potential for re-rating? Let's go across and listen in.
Are at 20x, give or take, let's say, for example, for Infosys. And this is when we are building a very modest growth for next 2 years. So the probabilities of that growth being beaten on the upside exist, and multiple going up also exist. So it's like the opposite of what it was few months back when we were kind of negative on the sector, because the expectations were high, multiples were high, meeting those expectations was difficult. Now we are seeing the opposite of it. And some of this company also have a very high payout commitment of, let's say, 85% odd, which would mean that at current valuation, they are yielding closer to 4%. So which is a decent yield, plus you have INR upside as well as modest growth. So that gives you a comfort of 10-12% kind of a return even in a weaker year like this. And if we see some uptake, then there could be a re-rating potential also.
And well, moving on to an ET Now exclusive, then sources say that government's monetization drive will take a hit due to volatility in the market, as Deepam believes it will go slow on listing of PSU's green arms. My colleague Prakash Pridashi is joining in with the details.
Yeah, we're learning from our sources that the government is likely to go slow on listing of various PSU's green arm during FY26. That's an important development coming in. We're given to understand that the process is likely to be delayed due to prevailing market conditions. In fact, sources are suggesting that the listing process will be fast-tracked if market conditions improve. And PSUs will remain extra cautious amid volatile market conditions. As you are aware that the government is planning to list green arms of various PSUs such as ONGC, NLC and SJVN, and sufficient gap will be maintained between two listings. However, SJVN and NLC have already started working on a listing process, but they'll hit the market at the appropriate time. DIPAM feels that the prevailing market conditions are not favorable, and therefore the PSUs will remain extra cautious. SJVN is planning to raise approximately 4,000 crore through listing of its green arm, whereas NLC also plans to raise a fund from the market along with the expansion of its capacity, renewable energy capacity, which is likely to cross 6 gigawatt by 2030.
Well, absolutely. Thanks, Prakash, for getting us that update. Tell you what, let's also take a look at some of the stocks that were buzzing away in trade, the likes of Bharat Dynamics as well as HAL up over 2%. In fact, for some of those counters, in fact, Rabinder is standing by with that list. Rabinder?
Well, as defense stock is in focus, where Nuvama has come out with a note on defense sector, and they have initiated a coverage on BDL with buy rating and target price of rupees 1615, and on HAL they have initiated coverage with buy rating and target price of rupees 5150, whereas on BEL they have maintained the buy rating and target price of rupees 385. On BDL they say that the company's revenue, EBITDA and EPS could grow a 55%, 62%, 55% CAGR over FY25 to 27, and on HAL they expect the revenue, EBITDA and EPS CAGR will be 26%, 19%, 12% over FY25 to 27, which is driven by the strong execution. And on BEL, BEL remains a top pick from the defense sector for Nuvama, and they have revised FY25, 26 and 27 EPS by -5%, -2% and 9%. Moving to next, Kansai Nerolac were also in focus, where management recently met with the analyst, where company said that they are targeting a 9% revenue CAGR over next 3 years and EBITDA margin of 14 to 15%. Moving to next, Devyani International were also in focus, where Board of the Director of the company is scheduled to be held on April 24, 2025 to consider and approve the definitive agreements and issuance of equity shares of the company on preferential basis to discharge the consideration payable for acquisition of controlling equity stake in Skygate Hospitality Private Limited, operating restaurants under the brand name Biryani by Kilo. And there are also some brokerage note coming on Devyani International, where MK has upgraded the stock to buy and raised target price to rupees 200, and Kotak Security has maintained the buy rating on the stock with target price of rupees 190. Moving to next, GAIL were also in focus, where PNG RB issue a consultation paper for review of natural gas pipeline tariff covering 10 pipeline operated by GAIL. And lastly, Divi's Lab were also in focus, where company has entered into a long-term international manufacturing and supply agreement with a global pharma company for advanced intermediaries, and the deal is expected to contribute significantly to revenue, and is planning for capacity addition to its manufacturing facility with an estimated investment between 650 to 700 crore and to be funded by internal accruals.
All right, with that, it's curtains down on this edition of Your Trades. Shreyansi and I will take your leave. Thank you so much for tuning in.